Welcome to the deep dive. We're here to cut through the clutter and get you the essential knowledge, quickly and clearly. Today, we're zeroing in on something really important. Using cyber insurance strategically, like as a real tool to boost cybersecurity. We're particularly interested in how this works for smaller businesses, SMEs, and also for state, local, tribal, and territorial governments, the SLTTs. They often face, unique challenges. We've got some great sources, including a really solid report from the Institute for Security and Technology to help us unpack it all. Think of this as your fast track to getting up to speed on a complex but vital topic. No getting lost in the weeds. And hey, a quick shout out to our sponsor right at the top, cyberinsuranceKelsey.com. They're a great resource if you're trying to get your head around cyber insurance. Okay, let's jump in.
Yeah, it's fascinating, how the whole cyber insurance story kind of tracks alongside the evolution of cyber threats themselves. You can almost see distinct phases.
Absolutely. The report, it actually takes us way back, mid-90s to early 2000s. It's kind of wild that the very first cyber policy only popped up in 1997. AIG saw a gap an insurance broker pointed out. And the initial focus, surprisingly narrow, mainly legal costs if credit card data got breached.
That's right. And in those early days, the report calls it the experimental cyber period, which I think is perfect. There just wasn't much actuarial data. The historical loss info insurers usually lean on.
Right. No track record.
Exactly. So they had to get creative. You saw AIG offering lower premiums for companies that actually got security audits, got certified.
So right from the start, there was this link.
Right.
Invest in security, maybe pay less for insurance.
A direct link, yeah. And it wasn't just AIG dipping their toes in.
Oh.
The report mentions others. J.S. Wursler apparently charged more if you used Windows NT based on hundreds of security checks they did.
Wow, that's specific.
Yeah. And AIG, again, giving discounts if you used a certain security device from Invicta Networks. Lloyd's of London gave like a 10% break for using Tripwire software. Hiscox was even looking at the security of their clients' internet providers and other third parties.
That sounds much more involved, like they were really looking under the hood compared to maybe later periods.
That's a key point. It was very hands-on, direct incentives, pretty deep security checks. It shows they understood early on that, managing security properly could directly impact the insurance side of things, the risk and the cost.
Okay, so that phase gives way to what the report calls the data breach era, mid-2000s to late 2010s, roughly. What was the big shift there?
The main thing was all the new data breach notification laws. California kicked it off in 2003. Then SEC guidance in 2011 really added fuel.
Right, suddenly companies had to report breaches.
Exactly. And that meant facing real heat lawsuits, bad press, you name it. So naturally, more companies started thinking, maybe we need insurance for this. Demand went way up. The market grew from under $100 million in 2002 to maybe $500 million by 2011.
And then things changed again around 2015, something about a soft market.
Yeah, basically more insurers jumped in, competition increased, and that pushed premiums down.
Lower prices sounds good for buyers.
Well, yes, but it had another effect. Loss ratios for cyber insurance in the U.S. were actually pretty low in 2015, lower than general property and casualty.
Okay.
And because the market was so competitive and losses seemed manageable,
right,
the way insurers checked out potential clients, the underwriting, it got, less intense.
Less intense.
Instead of those deep dives we saw earlier, they started relying more on, let's say, lighter touch security questionnaires, often asking more about how much data you had, what type it was, and maybe less about how mature your security program really was or the nitty-gritty tech details. There was a 2017 study that looked at these questionnaires, and it confirmed that shift.
So less focus on the actual security posture.
It seems that way, and the report gives this perfect example. A small business CEO in 2015, they did everything right. Implemented the whole NIST cybersecurity framework, which is a big deal, very thorough.
Right.
But their premium still went up. Why? Because their revenue increased.
Yeah.
It shows that disconnect, Your security efforts weren't necessarily the main factor in the assessment anymore.
So it shifted more towards easily measured things like revenue, data volume, less about proactive security.
Exactly.
Yeah.
But then came ransomware, late 2010s onwards. And that just turned everything on its head again.
Yeah, ransomware really changed the game. It wasn't just data exposure. It was data being locked up, held hostage, demands for money.
Deletion, extortion, sometimes even physical impacts.
Yeah.
And it hit everyone. Big companies, small towns, you name it.
So the market had grown, right? More insurers, more money in premiums between 2015 and 2020.
Huge growth.
Yeah.
But ransomware hammered those loss ratios. They shot up significantly by 2020.
And that led to premiums going up.
Predictably, yeah. The market hardened, as they say. Higher premiums, insurers got much pickier about who they'd cover and what security measures they expected.
Did the underwriting get tougher again?
It did, especially for bigger companies. We saw a return to longer questionnaires, sometimes even site visits, kind of like the old days.
But what about the smaller guys, the SMEs?
That's where the gap is. The assessment for them often stayed pretty basic, maybe just a few questions. And the really worrying thing the report flags is how few SMEs actually have cyber insurance. Like only 10% of those under $100 million in revenue in 2024. That's a massive exposure.
Wow, only 10%. That's concerning. So how are insurers trying to figure out the risk now, especially with those smaller players?
Well, we're seeing more tech step in. Security scans are a big one, some done by the insurer, some by third parties.
Okay, automated checks.
Right. And cloud providers are getting involved too. Like AWS has its Cyber Insurance Competency Partner Program. Google Cloud has its Risk Protection Program. The idea is if you use their platform and its security tools, it's easier to get an insurance quote.
That makes sense, leveraging the security they already provide.
It does. And you also have these third-party security rating companies like Security Scorecard or BitSight. Their scores are increasingly being used in underwriting.
So like a credit score, but for cybersecurity.
Kind of, yeah. But the report's careful to point out these scans aren't foolproof. They might miss risks from, say, outsourced services or clever honeypots set up to trick scanners or, critically, supply chain vulnerabilities. They have to be just one piece of the puzzle.
Right, not the whole picture. Okay, so we've seen this back and forth, sometimes focused on security, sometimes less so. Where does the report see the real strategic opportunity for insurers now?
It boils down to three main reasons why insurers are, perfectly placed to actually help improve overall cybersecurity.
Okay, what are they?
First, just basic alignment. Insurers and the businesses they cover, they ultimately want the same thing long-term. Fewer cyber incidents. It saves everyone money and hassle.
Makes sense. Fewer claims, less disruption. Win-win.
Exactly. Second, insurers get this unique view because of all the claims data they collect. They can see what security controls actually work in the real world when things go wrong.
Right.
It's not just theory or expert opinion. It's based on actual loss events.
That's powerful. Real-world data on effectiveness.
Hugely powerful. And third, think about all the real-time data potentially coming from security tools now. Insurers could get much deeper, maybe even continuous insights into a company's risk. This could allow for way more proactive risk management.
So spotting potential problems before they lead to a breach.
That's the potential, absolutely.
Right.
But, and this is a big but in the report, the market isn't really there yet. The main focus is still often on dealing with the mess after a breach, not so much on incentivizing stronger security before it happens.
Okay, so how do we get there? How do we push towards being more proactive? The report talks about sticks and carrots, right?
Yes, exactly. Those are basically the two main levers insurers can pull. Sticks are the negative consequences. Refusing to insure someone, limiting their coverage, or denying a claim if they didn't meet security requirements.
And carrots?
Carrots are the positive incentives. Giving discounts on premiums, maybe rebates, for having good security practices.
Let's look at the sticks first. Just saying, no, we won't cover you. That sounds harsh.
It is, and the report notes it's not very popular, especially when insurers are competing for business. Companies can often just go elsewhere.
Okay. What about reducing coverage?
Also tricky. You need really clear policy language saying exactly which controls matter and how failing on them impacts coverage. That's hard to write and enforce, and sometimes the technical reality is more complex than the policy language allows for.
And denying claims, that must be a big stick.
You'd think so, but it can backfire. It often leads to lawsuits, like those cases mentioned in the report where companies sued after claims were denied.
Right.
And maybe surprisingly, the data suggests insurers might not deny claims as often as people assume. A 2022 survey found that in most ransomware cases where the victim had insurance, the insurer did pay at least some of the costs.
So the sticks have definite drawbacks. They don't seem ideal for encouraging ongoing improvement either.
Right, they're mostly about the point of sale or after a claim. That brings us to the carrots, which the report suggests hold more promise.
Makes sense. Positive reinforcement often works better. And actually, before we dig into those carrots, let's quickly thank our sponsor again, cyberinsurancecals.com. If you're navigating the cyber insurance world, definitely check them out.
Okay, so carrots. How can insurers incentivize better security? One way is the straightforward upfront discount or maybe higher coverage limits if you demonstrate good security when you first apply.
Like meeting certain standards.
Exactly. Like following the CISO cybersecurity performance goals or NIST 800-1721. The report mentions this was actually pretty common way back in the early days of cyber insurance.
But that's still mainly at the beginning, when you buy the policy. What about keeping security strong throughout the year?
Good point. That's where things like co-marketing partnerships come in. This is where an insurer teams up with a security vendor.
How does that work?
The insurer might offer a discount or better coverage if you use that specific vendor's product or service. The report lists examples like Cloudflare's cyber risk partnership, or at Bay giving breaks for using Microsoft 365 with multi-factor authentication.
So the insurer trusts that security product and you get a benefit for using it. Seems like a win-win, especially maybe for smaller businesses.
Definitely beneficial for SMEs, yeah. It simplifies things. Then there's the concept the report really dives into. Bundling.
Bundling. Okay, what is that exactly?
This is where the insurance policy is combined with some kind of non-insurance security product or service. You pay an extra fee for it, but it might lead to a lower cost for that service. Or maybe you get a rebate on your insurance premium over time.
So it's more than just a discount for using a certain tool. It's like an integrated package?
Kinda, yeah. It's distinct from what the report calls embedded policy features. Those are things included standard with the policy, no extra cost, like maybe vulnerability alerts.
Okay.
And it's also different from, say, digital forensics and incident response DFIR services. Most insurers have panels of DFIR firms ready to help after a breach. That's usually an included post-breach service, not really proactive bundling in this sense.
Got it. DFIR is reactive. Bundling is about adding proactive security services alongside the insurance for an extra cost, but with potential premium benefits over time.
Exactly. It's about encouraging ongoing risk reduction. And the report gives some current examples. Chubb works with Sentinel Loan. Coalition has its own platform, Coalition Control. Beasley has an in-house security unit and partners with others like Security Scorecard.
So it is happening now.
It is.
Yeah.
Cowbell offers a managed detection and response service. AKA XL partners with Dark Web IQ. Coalition even gives premium credits if you use certain approved MDR solutions.
That sounds like it could be really valuable, especially for those SMEs you mentioned, getting access to services they might not otherwise afford and potentially qualifying for better insurance.
That's the potential benefit, yes.
Mm-hmm.
Affordability, better security, better insurance access.
But if it's so great, why isn't it more common? The report mentions barriers, right?
Yeah, several things are holding it back. One is just the inertia of the traditional insurance market. Cyber is still pretty new, relatively speaking. Big, established insurers might just be slower to adopt these kinds of innovative risk management approaches. Market conditions matter too. Hard market versus soft market influences appetite for new things.
Okay, market dynamics. What else?
Reinsurance is a factor. The companies that insure the insurers, they might be cautious about cyber risk volatility, and that can make them hesitant about bundling.
And then there are the regulatory hurdles you mentioned earlier at the state level. That sounds complicated.
It really is. It goes back to these old anti-rebating laws, mainly from the life insurance world in the late 19th century.
19th century laws affecting modern cyber insurance.
Strange, but true. They were originally meant to stop unfair pricing, protect against insurers going bust, make risk clear, and prevent anti-competitive stuff.
So how do they block bundling security services today?
Well, the National Association of Insurance Commissioners, the NAIC, they updated their model law in 2020. It basically says insurers can offer value-added services for loss mitigation, risk assessment, education, etc., as long as they're offered fairly and priced reasonably.
Okay, so the model law allows it.
But it's up to each state to adopt it. And the report says as of early 2025, it's roughly split. About half the states have eased these restrictions, but the other half, plus D.C., still have the old rules on the books.
A patchwork quilt of regulations.
Exactly. And that makes it really tough for an insurer wanting to offer a bundled product nationwide. It creates uncertainty, a chilling effect, where maybe they just decide it's easier not to bother.
That makes sense. Beyond the state laws, were there other specific concerns raised about bundling itself? Like, could it make insurers less stable?
The report addresses that. Insolvency is always a background concern in insurance, needing good regulation. With bundling, one specific worry is risk concentration. What if an insurer bundles heavily with just one or two security vendors, and those vendors have a problem?
Like if that vendor gets hacked themselves?
Precisely. Think about the Change Healthcare incident mentioned. If everyone's using the same vulnerable MDR service bundled by their insurer, that's a huge systemic risk.
Yes, but the flip side is bundling, done right, should reduce risk overall by making policyholders more secure. And insurers could actually help diversify risk by guiding clients away from overly dominant vendors.
What about pricing and understanding risk? Does bundling help or hurt there?
The argument is it can actually help. Getting data from bundled services like an MDR could give insurers much better, deeper insights into the actual risk environment than just a questionnaire. Transparency is key, though, especially comparing an insurer's own in-house service versus a third-party one.
And the risk of unfairness, like insurers only partnering with certain vendors.
That's a definite concern. These value-added services should be available to everyone who qualifies objectively. The worry is insurers might pick partners based on profit motives, not purely on security effectiveness.
Especially since the cybersecurity services market isn't heavily standardized yet, right? There aren't widespread certifications for everything. So regulation is needed to make sure it's fair and doesn't stifle competition. The report suggests extra scrutiny for in-house bundling, where the insurer owns the security service, because of potential conflicts of interest.
Conflicts of interest.
Yeah.
Like pushing their own service even if it's not the best.
Potentially, yeah. Or prioritizing deals that give them better market share. You need rules around disclosure, data protection, and watching out for vertical integration, where one company tries to control too much of the chain.
Okay, so bundling really does seem like a powerful potential carrot. It could genuinely improve cyber resilience, especially for smaller, more vulnerable organizations, by making proactive security more accessible and incentivized.
That's the hope, absolutely.
But it's not simple. There are real complexities, the patchwork regulations, potential risks like concentration or conflicts of interest that need careful management.
Exactly. It's promising, but the details matter, and the regulatory side needs to catch up to enable it properly while still protecting everyone involved.
Well, this has been incredibly clarifying, a real deep dive into how cyber insurance is evolving and the role it could play. And the report's main takeaway, its recommendation.
Yes, recommendation 1 is pretty clear. It says regulators and policymakers should actively encourage insurers to offer more of these proactive, pre-breach tools and strategies. And it specifically calls out bundling insurance with security products and services as a way to do that.
It definitely leaves you thinking, how will this keep evolving as threats change and regulations hopefully adapt? And maybe what role can informed people like us play in pushing for solutions that are both effective and fair? Thank you so much for joining us on this deep dive today. We really hope this was valuable, and we encourage you to check out the source material if you want to go even deeper. And one last time, a big thank you to our sponsor, cyberinsuranceKelsey.com. They're a fantastic resource for anyone trying to understand cyber insurance and how it fits into your overall security strategy.